Hello everyone, welcome to our discussion about Chapter 11 and Service Department and Joint Cost Allocation. So before we get into especially the Service Department cost allocation, first of all I want you to understand that service departments are typically situations in a business that would be typically treated as period costs, which means from an accounting standpoint these are going directly to the income statement. They're not usually considered cost of the products and included in cost of goods sold or inventory or any of these things. They're non-inventoriable costs. So we're kind of going outside of the norm. We're kind of saying, okay, we're going to take this idea of allocating costs and especially activity-based allocations to kind of an extreme. We're saying, okay, here's costs that we normally think of as separate from the production process, but we know that the production departments use services from these service departments. So these are the kinds of departments that perhaps do payroll or human resources or IT, information technology, any of those things that are not directly tied to products, aren't really considered manufacturing costs, but yet we know that the manufacturing departments utilize these. They provide these service departments provide support for those other departments. The service departments don't make a product that is going to be sold to external customers. All right, they exist solely to support the manufacturing departments. So why do we allocate? Why do we look at this idea? It really does come back, and in reality, we will probably not make journal entries to reflect any of this because what we are doing is simply analyzing the costs that we would have recorded as period costs anyway. So the journal entries are not affected. T accounts probably aren't affected. These kinds of, you might say, very overhead costs that are very indirect. But when we allocate them and analyze them in this way, break them down into pieces, that sort of thing, what we're trying to do is get a handle on what it is that makes them go up. How can we manage them better? All right, how can we better utilize these services? And unfortunately, in some cases, that may lead to us to find a more efficient that might involve, say, outsourcing. So for instance, we start looking at how much cost it is for payroll and things like that, and we start to say, would it be better for us to have that be done by somebody else, someone who only does payroll expertise somewhere else, and therefore freeing up our expertise and our resources to focus on what we do very best. And so that whole idea of the value chain, if the value that we're providing isn't sufficient to justify the cost, maybe we need to rethink how we do these functions, these service department functions. All right, so I don't want it always to be about whether or not we do it in-house or out of, make or buy, but that is often the context which is looked at. There are other ways to look at managing the cost without having to say, oh, we're just going to chop it all together, sort of thing. So just as how this might work out, okay, we've got an example. We've got two manufacturing departments or user departments, Sierra and Cascades, okay, and we have two service departments, information systems and administration, kind of a catch-all type of a department. And we know that the service department provides stuff for both Cascades and Sierra. We know the information systems provides things that are needed by the people in the Sierra track and the Cascades track. But we also have this possibility that information systems provides services for administration, and administration provides services for information systems. And how much we're going to worry about that is kind of drives how we allocate these service department costs. All right, so putting some numbers to this. All right, we have the two service departments, I should say, information systems S1 and administration S2. They both have the same departmental costs: $800,000 for information system, $800,000 for administration. But what happens, administration is of the information systems, administration uses 50%, Sierra uses 10%, Cascades uses 40%. Administration, has some of it's used by information systems, Sierra, and Cascades. And you see, because the way that we're looking at in information system is hours, and from administration standpoint, number of employees. So you're already starting to see one of the purposes, and that is to think through what it is that makes these costs go up. What's the cost driver? And so we've thought that through and came up with hours and employees as our best ones. And again, no perfect cost driver, so there could be others that may work just as well. All right, so first method that we're going to talk about is what's called the direct method. And this basically ignores the idea that information system provides services to the administration and vice versa. All we're going to do is look at, okay, here's our service department cost, information systems, $800,000. We're going to look at the computer hours that are used by the Sierra track and Cascade track, that total. And then we're going to allocate basically a percentage to the Sierra track based on their percent of the total that are used by the user departments. And we're going to do the same thing with administration, except we're just going to, instead of basing it on computer hours, we're going to base it on employees. So that's going to look like this, and we're ignoring that they provide services to each other. So if you look at this the information systems, they provide 20,000 hours to the Sierra track and 80,000 hours. The fact that it's this percentage doesn't matter anymore because we're going to ignore this 100,000 hours. We're basically going to say, okay, Cascade uses 4 times as much as Sierra, so they're going to get 4 times as much of the cost. Or 80% of the hours that are used by the two producing departments is Cascade, so they get 80% of the cost, and Sierra gets 20%. Over here, we're going to ignore the fact that administration provides supervision in the information systems department. We are just going to look at the fact that 5 out of 8,000 employees are in Sierra, and so they're going to get 5/8 of the cost, and the Cascade track is going to get the other 3/8 of the cost. And we're not going to allocate any of the costs of the service departments to each other. So what that ends up being is we got the 20%, 80% I mentioned, 62, that's 5/8, and 37, it actually gives you the formulas of how you might do it in Excel to get that, all right? And so $160,000 out of the information systems cost, it goes to Sierra because it was 20%, right? And Cascade gets 80%, or $640,000. So there's the cost. Oh, I guess earlier where I said it was the same cost for each one was in error. It's actually $5 million for the administration, a lot bigger amount of cost. And we allocate that 62.5%, I should say, $3.1 million and $1.875 million. So the cascade track. So we're done. We don't have to do multiple steps. We simply take those, treat them like we would any of our overhead costs. We kind of and allocate them to the operating departments. That's the direct method. That can be a little misleading in a situation where a significant amount of the IT is provided to another service department, okay, because you're kind of ignoring that. So what happens is every operating department is only compared against other operating departments, and you really don't consider at all the other service departments, especially if they use a significant amount, like in this case where it's almost 50% goes to administration. So that brings us to the step method, okay? So the step method allocates some service departments to other service departments, especially those that are get a lot used, okay? But we don't allocate back. So if we allocate from IT to administration, we don't allocate administration back to IT. We allocate from IT to administration, and then administration now has higher costs to be allocated to the operating departments. All right, so we start in order. The homework that you'll be given will give you the order you need to do that and to do your step allocation or step method. So we're going to do it with information system being allocated to administration, to the Cascade track, to the Sierra track. And then we'll have to do, and that's why it's called a step. Step 2 will be taking administration and allocating it to the Sierra and Cascades track. But notice there's no arrow going back to information systems. So when we look at the $800,000 from the IT department, okay, obviously we don't allocate any of that cost to itself. We allocate 50% or half of it, because that was half of the hours goes to administration. Now it's back to that 10% of the hours was for the operating department 1 and 40% to the second one. We still have to have 100% of our costs allocated, right? Then once we have added in the service department costs, then we'll use this same process for the $5 million, and we'll allocate all of it to the 2 operating departments. None of it will go back to back to IT. So that means that $400,000, or half of the IT cost, goes to administration. $80,000 to Department 1, okay, $320,000, or 40% to the 2. That means now our service department, our cost of administration is $5.4 million, not $5 million. It's $5 million that it has of its own costs, and $400,000 that have been allocated from the other service department. That then is done 62 and 37.5%, 62.5% and 32.5% to the 2 operating departments, very much like it was done with the direct method. Add them together, and this is our total allocated cost to the 2 operating departments. 1 gets 3.4 and the 2 gets 2.3. Notice it is still the same $5.8 million. Okay, nothing has changed with our total. It's just a different way of allocating it. And we're going to focus on this step method. All right, there is a more complicated reciprocal method, okay, which tries with mathematical formulas to go both directions, meaning they allocate from IT to administration and from administration back to IT. It does require a considerable amount of writing of various algebraic expressions and things like that I don't think is important enough. I don't think it gives you a better enough information to make it worth the extra work. And so we're not going to do it in terms of I want you to be aware that it exists, but not necessarily the details about how to do it. So that means in the when we get to the appendix, we won't worry too much about the appendix in that regard. This is kind of how it would look. You'd have the arrows going both ways. All right. If we had done it all three ways, you can see that there is some differences between the three. If we had done it full reciprocal versus the step, we're going to primarily do the direct and step method of allocating these and not worry too much about that reciprocal. Okay. Now the other topic that we need to kind of wrap up with this cost allocation concept is the idea of allocation of joint costs. Okay, so joint costs are the costs that are incurred as we manufacture or make or grow or mine or whatever. We go through this process, and what we end up with is multiple products, not one thing. Okay, and so because those multiple products all had the same costs previous, those are referred to as joint products. And so they have this common production, common inputs, they have the same direct materials, direct labor, all that type of stuff. And at some point they split off, meaning either there's a sorting, for if you're growing things, they're sorted. You grow them in the field. You fertilize them all the same. All that kind of stuff. You prune the trees all the same way. You do all that kind of thing, and then at the point after you've harvested them, you've all got them. You get them back into the factory or whatever, the warehouse. You sort them and you say these are the very good ones, grade A, if you will, that are going to be sold in the grocery store. And then these are grade B that may be used in certain products or sold at a lower price or something like that. And then these are grade C. These are ones that you are going to chop up, and it doesn't matter if they have little blemishes. It doesn't matter if they have if they fell on the ground and got bruised or whatever, because they're just going to go into applesauce or whatever the product is that utilizes it. So that would be the case for most of your growing, most of your agriculture, but also a lot of your other extractive processes. Also, when you refine anything with petroleum, you go through the refining process, and at the end you end up with multiple products. So here's an example, kind of how you might graphically might think about this. Okay, although that's probably needs to change from mining costs to growing costs, because we're going to get it back and we're going to cut it up, and we're going to get a certain amount of grade 1 lumber. We don't mine lumber. Okay, if it was some type of extractive iron ore or something, we might have different grades of that. And number 2 grade lumber. And out of, we typically get about, you see, about 1/3 is number 1, and number 2 is 2/3. So we get more of the number 2, okay, because it has to reach, be certain grain of your lumber or whatever to get to grade 1. So you don't have it. Now this one only has 2, but you could have 3, you could have 10 different products. It would work basically the same way. All right, now the first kind of thing is, we also know that we sell, though, the grade 1 lumber at a higher price, right? So 15,000 units, whatever units we're using, sells for 300,000, while grade 2 lumber, 30,000 units, twice as many units, only sells for about 50% more, because they're getting less per unit, right? Because it's not as high a grade. So why do we do this? Well, part of it is just to see the relative profitability of our different products, to see if there are things we need to do to increase the volume of one or the other. Okay, we have to do it from an accounting standpoint to determine our inventory value. Okay, so how should we do this? Should we do it on the net realizable value method, which basically says, okay, we're going to allocate it based on how valuable the split off product is, or are we going to do it on just the volume of the split off product? All right, so net realizable value means as soon as we sort it, we have a value to sell it for. All right, sometimes we have to estimate that. We have to kind of back up. So for instance, let's say that we split off into grade 1 lumber and grade 2 lumber, but in order to sell the grade 1 lumber, it has to be packaged a certain way, okay, as grade 1 lumber. So that means that there is an additional cost. We know it'll sell once we've packaged it, but there really isn't a market for it before that. So we have to say, okay, we can sell it for this amount once we package it, minus the packaging cost gets us our net realizable value. So sometimes we have to do a little backwards thinking in order to get that net realizable value. So let's look at a simple example of our mill here that we're working on. We had the grade 1 lumber. Remember back in our earlier slide, we could sell it for $300,000, okay, $450. That's where that's coming from, okay, that we're using here in our spreadsheet. There was no additional processing costs for either one in this case, keeping it really simple. And so if you add those together, 300,000, 450, that's 750. You take 300 divided by 750, that's 40%, right, of your sales value is for grade 1, and 60% is for grade 2. So that we would take our joint costs, all the costs we did before we had split off, before we sorted it into grade 1 and 2 or A and B or whatever, that cost would be allocated 40% to grade 1 and 60% to grade 2, because the value is 40 and 60%. So now if we look at it from an income statement standpoint, 300,000 sales value, allocated costs equal our gross margin, okay, 64%. It's going to be the same for each grade. All right. So that's the maybe simplest, using the net realizable value. Okay, but what if we don't have a value right at split off? What if we have to do some other processing? In this case, for our grade 2 lumber. Okay, what if we have to do more things to it before we can sell it down the line? Okay, so we've changed the sales value, and we've added this idea that we have to do additional processing that we have to use to estimate our. So now, as you see, we build our spreadsheet. The grade 1 looks about the same as it was before, but the grade 2A is 550,000 what we can sell it for, but only if we do this additional processing to get it up to not just grade 2 but 2A, if you will, 50,000. So really the value is 500,000 net realizable value. So total net realizable value at split off is 800,000. 300 divided by 800, okay, that's 37.5%. We multiply that by the 270. Remember, we're still working with that same 270 of costs prior to the split off, joint costs. And then we allocate the same way, 62.5% to grade 2A. Notice that because of the additional costs, we have a lower gross profit, gross margin for 2A lumber than we do 1 lumber, all right? And so, but together, we have the total there as you see it, okay? So that's just having to make that slight adjustment based on having additional processing costs. Now, what if we just do it based on how much we make, right? On the physical, number of units, rather than worrying about the value at all. Maybe it's hard to put a sales value on it. And so we decide to do it based on a physical measure. And one of these things, product prices are going up and down all over the place, okay, and there's lots of things we have to do after split off before we can sell it, all right? So we might use this kind of concept where we have it based on quantity. So the sales value is $300,450, okay, but we're not worried about that. We're worried about how many board feet it was that came out with grade 1 and grade 2. And so you see it's 600,000 and 1.2 million of that board feet. So you see the cost 1/3 and 2/3, or 33.3% and 66.7%, however you want to think about it, okay, because it's based on this quantity. The sales value, while it's still listed, is so that we can do our gross margin, is irrelevant to allocating the cost. So now we have a very different gross margin percentage, because we take 300,000, and because there is a lot less quantity of it, there's a lot less cost, only 1/3 of the cost. So you end up with 70% gross margin and 60% for grade 2. Then once you've allocated that, if there were further costs to process it, okay, then you could then think through the idea of whether do we want to. We could sell this stuff at $450,000, but we could also sell it for more if we do some more work on it. Additional processing costs. So this is the concept of sell or process further. Should we sell it right after we sort it, or should we do this extra processing? And you can see that it's pretty clear that if your additional revenue is more than your additional cost, you should do it, right? The allocated cost from before the split off is irrelevant. It's a sunk cost, and therefore would not come into play in making our decision. So we would definitely want to go further, right, and make that extra $50,000. So just to wrap up here, this allocation between joint products works pretty well until you have what we might refer to as a byproduct. So we've just been dealing with two different products that are relatively close in value. But what if you have something that comes off of this process, these joint costs, that's really small in amount, meaning it's not that important? What should you do with it? And we refer to it as a byproduct. All right. In our example, we're going to use the concept of sawdust. And yes, if you're cutting up all this wood, you're going to generate a whole bunch of sawdust, and maybe you just throw it away. Okay, then it wouldn't really be a byproduct. It would just be waste. But maybe you say, oh, this is a lot of stuff, and maybe there's a value to it. Okay. So what should we do? How should we account for that value? If we can, we set up a way to gather that up, a suction system or something like that. All right, what should we do with? How do we account for it? Well, there's kind of two different ways, and again, usually it's not going to matter which way, because this is immaterial to our. You just need to be consistent. You don't necessarily. There's not a right way or a wrong way, but one, it needs to be consistent month to month, year to year. Okay. So method 1 says, okay, the byproduct is subtracted, the value of it, what we can sell our sawdust for is subtracted from the joint costs. So it reduces that 270,000 joint costs that we talked about earlier. And then you allocate the joint costs after you say, okay, well, our costs really aren't 270. They're 270 minus whatever we can get this sawdust, kind of a refund, if you will, of some of our costs is kind of how you're treating it. Or you can just count it as other revenue and not worry about working it into your costs of the other products. I think probably most people are going to use method 1, all right, because it I think more accurately reflects the overall cost, but again, it's not enough of a difference to make a difference, right? It's immaterial. So this would be the example, okay? If you count the $15,000 we can sell the sawdust for, it's a lot of money for sawdust, I guess, okay? So now your joint costs are not 270 or 270 minus 15, right? 255, and they get allocated, okay, the normal way, using the relative sales value or using the amount of board feet or whatever you would normally use to allocate. But instead of allocate, it doesn't change the allocation method. It just simply changes the amount that gets allocated. So instead of allocating 270, you're allocating 255, and you end up with these new gross margins. But you end up with, because you're using relative sales value, the exact same gross margin on both products. And then the other way is that the $15,000 goes directly to the income statement, doesn't affect your costs of joint costs or your allocation or anything of that nature. Okay, so you're not going to influence that.